A market bloodbath is underway. Today we'll break it down for you. What is causing all of this distress? My name is Paul Barron. Welcome back into the show. I want to thank our sponsor, and that is iTrust Capital. You guys can get over and get into long-term holding, which is what you should be doing in times like right now, and look at IRAs. And of course, you guys can do this with both crypto. You can do gold and silver. All of that, set it up. It's a great tax benefit. Obviously, seek out your own tax advice, but use our link down below. It's going to give you a $100 funding reward to get started and get underway. So use that. Let's go over to this first tweet. This, of course, came out. This was from CNN. I'm not sure to what extent this. The reporting is very spotty. Right now, it is that the U.S. deployed jets against Russian bombers, supposedly in Alaskan airspace. I don't know if this is the case. It is possible that the markets could be spooked because of this. I don't necessarily think that is the case. I think we're dealing more with a cycle thing right now. If you look at the government shutdown potentially as another possibly catalyst for what we're seeing in the market, right now this is now at a 75% chance. After yesterday, we did a video on this and a breakdown on this. Trump, of course, he doesn't appear to be interested in negotiations, so the likelihood is we might get a day or two or possibly more that could play into this shutdown. The other thing is job cuts. And I want to go to a clip real quick because this will get us into a framework of how this economy is doing. Take a look.
Now, this marks a significant escalation in rhetoric and threat from the Trump administration because normally we see those non-essential government workers furloughed but then brought back with back pay. Instead, we're seeing this memo from the OMB, which is directing agencies to come up with a list of workers whose activities are not paid for via mandatory funds or any new funding from the One Big Beautiful Bill, as well as to make a list of programs deemed inconsistent with the president's priorities. And these are the areas that could be on the chopping block. Now, OMB did not provide additional details. We don't know how big these layoffs could be, but it's important context to keep in mind that 6 out of 10 federal workers are typically deemed essential during shutdowns, which means that they keep working, while 4 out of 10 are told to basically stand by until Congress reopens the government. So, of course, this could have some very big economic implications here, Bonnie. But just for an update on how these negotiations are going, they're not going too well.
So this coming from the government job side of thing. Then you look at the most recent report. Jobless claims dropped 218,000 this week. Sounds great. You know, I put this tweet out. But there is some catch here. Last week's numbers were quietly revised higher. This gets me back to the point of, can we even trust this data yet or ever? I don't know. I still think it's bullish for markets in general, long term. But this happens all the time. Economic data, initial reports, grab headlines, blah, blah, blah. You get the point here. This was the kind of the situation right there on Reuters where they were just saying that jobless claims are falling, but labor market is softening. And I still think that is the bigger picture here, is that labor markets are still very, very soft, and that we'll go into the Q4 with a very soft labor market, which will put a lot of pressure, I think, on performance earnings as well as just in general the markets. Now, I want to go into this other thing that goes back to the shutdown potential, and this was in reference to how Trump was responding to it. Take a look.
So I think we're in for a shutdown, but not a long one.
There is at least a theory that the White House is hoping for this shutdown.
Doge earlier this year, and we know that the calculation that Schumer made earlier this year, part of the reason that he didn't fight through was because he was worried about federal workers.
Yes, right.
He was worried about the president's ability to kind of impound funds, if you will, pick and choose what's essential for the government.
When the threat could actually be greater now. Do you buy into this theory, Terry? The Trump administration is now in control of what is essential and what is not, and will use that power in a way that we've not seen before.
Yeah, I think both of those are true. Frankly, they have things that they want to roll out and things that they want to test.
All right, so you can see there's a lot of mixed feelings, I think, around the government shutdown, how much of an impact it will have on markets, but more importantly, how much it's going to have an impact on D.C. and, in tradition, government jobs that applied into this. I want to go also into tax credits, because this is another factor that comes into a bigger, broader impact on markets. Let's take a look at this clip.
Would it be possible just to get what you want? Because I know that Senator Johnson is he doesn't even want to do this. But others are ready to do it. They just don't want to get, taken to the cleaners with a bunch of other things.
I think it's a bigger problem that you're not acknowledging. The problem is not that we can't find a solution to this. The problem is that the leadership is not going to the table and sitting down and negotiating, because if they negotiated, we could find a way to deal with this. We have Republicans who are interested in extending the premium tax credits, and the president should recognize that. Even his own pollsters say that we don't extend these tax credits, the GOP is going to pay at the polls next year.
If you're going to shut the government, shut it.
Everybody needs to stop the kabuki theater and go to the table and negotiate.
That's the only way it's going to get done, is I think through negotiations. The impact on the market, it's pretty dire. Breaking right now, U.S. stock market futures ended a 3-day loss, down 2% after obviously we saw Powell pushing back on the rate cut hopes, which is the problem I think that also could be playing into this. And you can kind of see the U.S. 500, the U.S. Tech 100, everything was down considerably, including the small cap 2000. So this is another factor that plays into this. The S&P has historically been expensive based on valuation metrics before anyway. So that's another thing that could be pulling off, is that the market has been too frothy. There is some adjustment here going forward. Now we're getting into Bitcoin here in a second, but I do want to remind everybody, if you guys are not part of our Forge membership, make sure and get in on that. You guys can just visit our website, click on the top banner, it'll just take you over to memberships right there. What you get there is our Bear and Brief, that's an email. You can get into our BCI, which is our 50 tokens that we follow very closely, a little bit on the our own portfolio, and then all sorts of tools, including our indicators. So check it out. Plus you get in on our Telegram group over there. Now let's talk about Bitcoin, because Bitcoin is another factor here. We're seeing it start to adjust now. Is under a 100K Bitcoin in the cards? Here's the ETFs now entering a little bit of a slowdown phase, and I think a lot of people are now starting to look at maybe an under 90K position. The slowdown in spot Bitcoin ETF signals again against institutional demand. So this is a factor. 108 is the short-term target for bears, and there are some analysts predicting a drop to 90K. I don't know if 90 is in the cards, but it would be a significant pullback, and that, of course, would wreck the altcoin market dramatically. The question would be is how would Bitcoin come out of that, and would that pretty much cancel the altcoin market? I think there's a lot to look at. Leading the altcoin market typically has always been Ethereum, and Ethereum now has fallen below 4,000 for the first time in 6 weeks. I'm not necessarily worried about this just yet, but there are some key points of where ETH could go that could concern me. So again, if you're not in a Forge membership, because we talk about those things all the time in there. BlackRock has sold 25,600 in ETH today, and now institutions are wanting a lower entry on ETH. Maybe this is a bigger play toward, ideas around manipulation. Everybody's looking at all sorts of things, shutdown, issues globally, what we're dealing with on the EU front, and now what we're dealing with in terms of maybe even market manipulation around some of these major tokens for sure. Now, is a reset good for the market? Well, this clip will explain a little bit more. Take a look.
You really shouldn't short an overbought market. That's usually get your butt handed to you.
That's right. I always caution against shorting anything that's at or near all-time highs. I think that's really not advisable to anyone, because it means there's no resistance on the charts, the positive momentum is there, and of course we do have that for the major indices. But listen, we've avoided the seasonal pullback so far.
Will we avoid it?
I think not, probably, but we don't have the indications yet.
Something between now and mid-October we will see.
That's very natural. Usually you see it towards the end of September. And wouldn't that be a great reset for the market? If you look around, especially in the AI names, it's extremely overextended in its appearance. Overbought's not a bad thing. That's a reflection of momentum. It's when you see that overbought reading give way to downturns, and you can simply follow that using stochastics or RSIs, and you'll see it on a broad basis, I think. We moved to a bearish short-term bias this week in our research for Bitcoin, but it's within the context of an intermediate-term range that follows a long-term breakout.
All right, so we are there. What we're talking about is the seasonal market structure resets, and maybe this is basically just going and following the plan in terms of the size and I think the alignment of where the market is timing-wise. Now, there's some other things that play into this, and one of them is always the pressure on Trump's administration. Well, Senator Warren continues to do that, calling for investigations against President Trump's family over foreign crypto deals. This, of course, is all relating to WLFI, but at the same time, on this same day, WLFI gets listed by Robinhood, and of course, we see an immediate impact from that as well. So, I don't know. This is, it's a very unusual setup for going into what could be a blow off top, but also could be an extension in this market. And I think that's something to kind of take a look at. Here was a tweet by Ionic XBT, and he hits on a couple of points, but kind of a good news, bad news concept. This will be the final crypto cycle. I guess that's bad news in terms of parabolic moves. Okay. So if you've been in crypto cycles in the past, parabolic moves, that's why you're here. If you're brand new to crypto, a 30% move might be parabolic to you, but in reality, we've seen hundreds of percentage moves, thousands of percentage moves in the past. So that's a factor that could be happening. And Q4 and also Q1 of 2026 could be the zone of peak euphoria. So that could be the cycle ending. And it could push past the end of this year, which would definitely be outside of the 4-year cycle, especially when we look at Bitcoin halving as kind of being the indicator there. Raoul Pal, who's been on our show before, has kind of talked about this a little bit. He goes on in this video to talk a little bit more about this elongated cycle, though. So it's an interesting take. Take a look.
Remember, we've always said it's the business cycle stupid. It is always the business cycle stupid. And all of these people who claim it's the 4-year cycle based around this and that, they don't understand the fundamental of what the business cycle is. You see, rates should have come lower. They need to come lower because rates are so high has meant that Main Street has been screwed while Wall Street's made money from debasement. Earnings versus scarce assets. This is the issue that they need to solve, and they need to get rates lower. Why do we have an elongated business cycle that looks like virtually no other real other time? Is that in 2021-22, they actually extended the maturity of the debt from 4 years to 5 years. So that extension of the maturity of debt has pushed out the business cycle a year. The 4-year cycle this time around is a 5-year cycle. We don't know what the next one will be until we see where they all end up getting refinanced. And it tells us the ISM should peak by 2026. We think liquidity probably peaks before that. As the rate of change of ISM changes and the rate of change of liquidity changes, our best guess remains well into 2026, probably Q2.
All right, so there you have it. So it is pushing it out a little bit. This could mean that we're just in late stage. If you think about what Tom Lee has talked about, he still looks at end of year. The last point I would say is that would help the market is if we see the turn on job numbers coming back. If that all comes in, and I know a lot of things in the pipe there in terms of potential, but those are the things we're watching. Hey, listen, that's why you guys follow this channel. So again, if you're not in the Diamond Circle, get in right now. It's a free list to join, very easy. We send out an email every week, so it's super easy, and I think it's one of those things that if you're brand new to crypto, definitely worth it. Follow me out there on X, just at Paul Barron, and of course, we'll catch you next time right here on The Paul Barron Show.